To most people, BlackRock is just a name rarely discussed in daily conversations, rarely trending on social media. Yet behind the scenes of the global economy, this single institution quietly holds influence over trillions of dollars, shaping markets, governments, and the financial future of millions of people around the world. BlackRock is not a bank in the traditional sense. It does not take deposits from ordinary people, nor does it issue loans like commercial banks. Instead, BlackRock is the world's largest asset manager. It manages money on behalf of others' governments, pension funds, insurance companies, corporations, and individual investors. What makes BlackRock extraordinary is the sheer scale of that responsibility. At various points in recent years, the firm has managed assets worth more than the GDP of most countries on Earth. The company was founded in 1988 by Larry Fink and a small group of partners. At the time, BlackRock was focused on risk management in bond markets, an area that many firms underestimated. Fink believed that understanding risk, not just chasing profit, would define the future of finance. This philosophy became the foundation of BlackRock's rise. Over the decades, BlackRock expanded aggressively. It entered stock markets, real estate, private equity, and exchange-traded funds. Its most famous product, ICE, turned BlackRock into the dominant force in investment vehicles that track entire markets and are used by millions of investors worldwide. Through these funds, BlackRock gained stakes in thousands of companies, not by owning them outright, but by holding shares on behalf of clients. This is where BlackRock's influence becomes controversial. Because BlackRock manages shares in so many major corporations, it often appears as one of the largest shareholders in companies ranging from technology giants to energy firms, banks, airlines, and pharmaceutical companies. While BlackRock does not control these companies in a direct sense, it holds significant voting power. That power allows it to influence corporate governance decisions, executive compensation, and long-term strategy. Critics argue that this creates an unprecedented concentration of economic influence. A single firm, acting as a steward of other people's money, now has a voice in how large parts of the global economy are run. Supporters counter that BlackRock's influence is overstated and that it simply reflects the trust placed in it by investors seeking stable returns. Another key pillar of BlackRock's dominance is technology. At the heart of the firm lies a powerful platform called Aladdin. This system analyzes risk across financial markets, tracking thousands of variables in real time. Aladdin is not used only by BlackRock. Governments, central banks, and rival financial institutions also rely on it to assess risk and manage portfolios. During times of crisis, this system becomes even more important. When global markets collapsed during the 2008 financial crisis, governments turned to experts who understood risk at a systemic level. BlackRock emerged as a key advisor. Years later, during the economic chaos caused by the COVID-19 pandemic, BlackRock was again called upon by the U.S. government to help stabilize financial markets. These moments cemented the firm's reputation as an indispensable player in times of crisis. But this close relationship with governments has raised concerns. Some critics question whether it is healthy for a private company to have such deep ties to public institutions, when the same firm that advises governments also manages trillions in assets. Questions about conflicts of interest inevitably arise. BlackRock maintains that strict ethical walls separate its advisory roles from its investment business, but skepticism remains. BlackRock's role in environmental, social, and governance issues has also sparked debate. In recent years, the firm publicly emphasized the importance of sustainability and long-term value creation. Larry Fink's annual letters to CEOs have repeatedly warned that climate risk is investment risk. As a result, BlackRock has pushed companies to consider environmental impact, diversity, and governance reforms. Supporters view this as responsible capitalism. Critics see it as unelected influence over corporate and social policy. Either way, BlackRock's stance demonstrates how financial power can shape global priorities without passing through democratic systems. Despite its size, BlackRock operates largely out of public view. It does not advertise to ordinary consumers. Its executives rarely seek celebrity status. Its power lies not in visibility, but in infrastructure. BlackRock sits beneath the surface of the global economy, connecting markets and institutions through capital flows and data. This invisibility is part of its strength. BlackRock does not need to control countries or corporations directly. By managing the systems that allocate capital, it influences which industries grow, which companies survive, and which projects receive funding. In modern capitalism, capital allocation is power. Yet it is important to separate fact from fiction. BlackRock does not own the world. It does not dictate global events in secret. Its influence comes from trust. Investors voluntarily hand over money. Governments seek advice, and institutions rely on its tools. But concentration of trust itself can become a form of power. The story of BlackRock reflects a broader truth about the modern world. Power no longer resides only in armies or governments. It flows through financial systems, algorithms, and institutions that most people never see. BlackRock did not conquer the global economy. It optimized it. The real question is not whether BlackRock is too powerful, but whether the world fully understands how modern power operates. Because, in the age of global finance, the most influential forces are often the quietest ones.